What is going on, you guys? It's good to see everybody here. Okay, I think we got a lot of cool things to talk about here today. I do think what we're going to do is we're going to start. I'm going to just kind of getting everything all set up here. What I wanted to do is actually talk a lot about. I think I'm actually going to probably have this set like this. So what we're going to do is we're going to talk about a lot of stuff. But first, I wanted to talk about macro, and then make sure that I get into a lot of the opportunities and how I'm thinking about the markets in the years ahead. I do think that sometimes, like when we start talking about macro and we start talking about the markets, it's always kind of like, what's the trade? That's like one of the most important things. Is it's great that you're giving me all sorts of awesome advice, but at the end of the day, it's like, what's the trade? Like, how are you thinking? How are you approaching the markets? And that's something that I really try to do and try to bring to every video that I do for you guys. So I think that what I wanted to do was actually start probably talking about macro, and then I think that as things kind of go up, we'll talk a lot more about some of the nitty gritty details, like specific portfolio actions that I'm going to make. But we did have a really busy week last week, right? And I wanted to actually talk a little bit about inflation and why I think that JPOW is actually doing what he's doing, and why they're continuously holding rates and still guiding for 3 rate cuts this year. So I thought that that was really interesting. I was actually expecting them to become a little bit more hawkish due to the recent inflation data. I was expecting them to actually move to 2 rate cuts this year rather than 3 rate cuts. But when I listened to him and I really had a better understanding of exactly like what he was trying to communicate to us, it made a lot of sense. So I do think that I think that that's something that I wanted to communicate to you guys, and show you exactly like what the overall trend of inflation is looking like. And then more importantly, also picking up on the exact nuggets that I ended up capturing, specifically around quantitative tightening. I do think that this is something that is very, very important to pay attention to as both traders and investors, because it is going to impact the direction of the markets. And this is something that nobody is talking about right now. And we're not talking about it because it's not 2022. During 2022, everyone thought that everything that was just about macro was super popular, but now anything that has to do with Nvidia is super popular. So it's like it's just cycles and how it works, but making sure that we still keep at the front of our mind this macro and like how liquidity does impact the markets, more specifically bank reserves, how those impact the markets is going to be important to pay attention to in the days, weeks, and months ahead. So let's talk a little bit about inflation. So I think that something that's really important to pay attention to is like, why is the Fed still guiding for those 3 rate cuts on a full year basis? And it really is important to pay attention to like where inflation did come from. Now, we are never going to be told this by our policymakers because it was their fault why we had inflation. Just like what ended up happening in the 1940s and 1970s, when you print an excessive amount of money, and also in I think it's 1917 to 1919. So those were 3 inflationary episodes that happened before this, and all of them were very similar. All of them were directly correlated to government spending and a massive increase of the money supply at any given point in time. So I do think that it's very important to always make sure to keep in the back of your mind that if it's like, what is the government doing with their deficit? Yeah, they ended up passing that 1.7 trillion dollar spending bill, but what we ended up experiencing in 2020 was vastly different than what we ended up experiencing, like what we're experiencing here to now, with the slight resurgence of inflation. And I'll talk a little bit more about that as we go along here. So when we do think about like what ended up happening in 2020, so if you guys remember, we were all locked down during that time frame, and we had a bunch of stimulus checks basically get thrown at the economy. So the thought process was during that time was to make sure that what ended up happening in 2008 doesn't happen again. So the way that deflation works and the way the deflationary busts work is that once you kind of begin the deflationary process, it acts a lot like a steamroller. And China is actually going through that right now. So like once you actually get a hole, think about it as like a black hole in the economy. So like when people can't pay their debts, that essentially destroys money, which is basically what happened in 2008, is that we had a massive contraction in the money supply. Same thing that ended up happening in the Great Depression. The money supply contracted. And when the money supply contracts, people obviously lose money. And when they lose money, they can't pay their debt back. And it creates this deflationary spiral. So that the way that the government really responded to both 2008 and 2020 is that they launched massive amounts of stimulus to basically plug holes into the economy through the use of government spending. So what ended up happening was that they actually did a lot more than what they needed to do. So during 2020, we obviously passed those stimulus bills, and it probably did save us and completely avert a Great Depression, which probably would have actually ended up happening because we're so leveraged up as an economy. But during 2021, we continuously passed more and more stimulus checks, despite the economy already heating up and also reopening at the same time. So you basically had like a fire that was going, right? So the fire was going, and then you basically threw gasoline on the fire, and then the result was essentially inflation. But you can actually see that directly within the M2 money supply when it ended up peaking here in that March of 2021 timeframe. This is like when they actually launched that. This is shortly after that third round of stimulus checks, if you guys can remember during that time, which obviously ended up leading us to inflation continuing until about 2022, June 2022. So yeah, you guys can see this. This is headline CPI, what we ended up experiencing. Now, keep in mind that uh, we didn't actually start the tightening cycle until December of 2022, December of 2022. That's going to be important to remember as we continue to talk about this. So, like I ended up mentioning here, paying attention to where inflation came from in the first place is going to be important for us to be able to contextualize and really understand exactly like what they're thinking about from a policy perspective, right? So like why is Jerome Powell, this is exactly what I'm trying to address here. Why is Jerome Powell still guiding for 3 rate cuts this year? And I do believe that it has a lot to do with the fact that we're not throwing out stimulus checks and the economy is cooling and the labor market is cooling, and more importantly, the trend of inflation is staying relatively stable and is declining. So in the week ahead here, we have the PCE data that's going to come out here. So yes, there's a slight acceleration on a year over year number. This is going to be on Friday, by the way, guys, before we get open. So we got the slight acceleration in headline C or PCE, and then we also have from these are the expectations, but the core PCE is supposed to stay relatively the same. So you can actually see here, and I wanted to make sure that I ended up pulling this up from Nick Timmeros. I absolutely love the charts that he gives us. So you can actually see like the 3 month, 6 month. So you can actually see like the rolling average of a lot of these PCE metrics here. So you can actually see that headline PCE is going to end up ticking up here. The core PCE is going to be basically the same, but otherwise, like basically the trend is down. And that's essentially what the Fed is looking at, is that, yeah, we do know it's going to be bumpy, but we do see that inflation is trending downward. And that was really reflective into actually the way that they ended up doing their summary of economic projections here. Hold on, I'm going to need a little bit of water. But when you can actually see, I think that this is very interesting here too, is like the way that they ended up guiding for PCE inflation. So keep in mind, PCE inflation right now is about 2.8. So we can actually go back to here. So this is going to be important to think about here. So right now, headline PCE is 2.5 is what they're thinking. And at the end of the year, they're thinking 2.8. Or sorry, we're at 2.8 right now. But when we go back to the summary of economic projections, so you can actually see core inflation is expected to tick down only 0.2 from their previous 2.4. So it's only supposed to tick down just a little bit more from where it's at. So the Fed is basically telling us that, yes, we understand inflation is a little high right now, but we do expect it to be high. Over the long term, we're still going to reach our 2%. And that's going to be, and we're going to make sure that we follow our federal funds path. And this is what we're thinking about. This is where basically our models are projecting. And you can actually see PCE inflation. Remember, the headline number was actually a little bit hot. That was going to be about 2.5, and that was supposed to see a reacceleration. But on a full year basis, they're basically saying that we're probably only going to see about 2.4% headline PCE inflation. So that to me is really interesting. That they're basically looking at today's numbers and expecting these numbers to essentially remain unchanged. But they're still guiding for those rate cuts. So this goes back to what I was expecting. Is I was actually expecting from the December projection that this number was supposed to go up, that highlighted number, that was actually supposed to go up into the 4.75% to 5% range, which is basically guiding for 2 rate cuts. But they didn't do that. But they did end up guiding for less rate cuts in 2025 and less rate cuts in 2026. Essentially, what they ended up doing is they ended up revising upward their long-term trajectory for what they expect the federal funds rate to be. So they basically raise the neutral rate. So you can see right here that a lot of them think about 2.5% is going to be that neutral rate. But I mean, it's all the way up here. So there's some members that do think that somewhere around like 3.9% is going to be the new neutral rate. Some think 3.5%. So the point that I'm trying to make here is that the Fed does think that inflation is going to be a little bit hotter this year, but the way that they're guiding for this, the way that they basically communicated to us as investors and market participants is that yeah, inflation may be a little bumpy this year, but pending any sort of unemployment recession or anything like that, we do still think that there's going to be about 3 rate cuts. But in the case that there is more weakness in the unemployment market or in the jobs market, they do think that that is essentially going to be a cause to increase the amount of rate cuts that we had this year, which is going to be a benefit to a lot of cyclical stocks like Tesla and a lot of the other solar stocks. But okay, so what I wanted to actually talk about, what is the most important here, was actually going to be what they ended up guiding for this last week about what they're thinking about from a QT perspective. So quantitative tightening is essentially a balance sheet roll off. Give me a second here. I'm actually going to try to clean out some of these tabs so I can have more space to talk and actually navigate this correctly. So when we're thinking about quantitative easing, is basically the Federal Reserve buying back bonds and or mortgage-backed securities. So what they think about is QT is the opposite end of that, right? So QT is basically going to be, they call it balance sheet runoff. So in this particular case, what they're doing is they're essentially letting securities mature and they're not replenishing them at a specific rate. I can't remember exactly what the pace is right now off the top of my head, but they're basically guiding for a slower pace. This is important. This is a very important development here. What I've been thinking about from the very beginning is that they're actually trying to address the reverse repo market. So during this time in the middle of 2023, when the bull market was going on, and a lot of people were talking about the pace of quantitative tightening, and they were saying, oh, the markets need to go down because we're quantitative tightening. But I remember looking at the reverse repo market and saying, well, there's about $2.3 trillion of, this is otherwise known as like excess liquidity, right? There's about $2.3 trillion sitting in the reverse repo market. Why would QT actually be influential to stock prices? And a lot of macro bears during that time didn't necessarily think about that. So like when I'm looking at the reverse repo market, when the Federal Reserve is basically telling us right now that they want to slow down the pace of balance sheet runoff, what they're thinking of is they're looking at the reverse repo market and they said, yeah, we're making a lot of progress here. Now let's actually try to land this effectively. So I do think that they're actually going to hit a point where this reverse repo market is going to go to zero. And that means that we need to pay attention to something that's a little bit more important here. And that's going to be the bank reserves. So bank reserves are essentially what from like a liquidity, right? Okay, so let me contextualize this correctly. So this is essentially when people say liquidity or market liquidity, they're essentially talking about bank reserves, because bank reserves are basically there to act as like a backstop to a lot of banks, and then they can use that to actually buy government securities and things like that, specifically T-bills. So with the bank reserves and this part of the equation here, when the Fed actually accomplishes the full balance sheet runoff, by lowering the reverse repo market down to zero, we need to make sure that we're paying attention to the bank reserves. And the reason why is I can actually point out right here in August of 2014, and I actually wanted to show you guys some really interesting catalysts on how liquidity and how the Federal Reserve plays such an important role in stock prices, specifically when they start using their balance sheet. So I'm actually going to go back and forth between the bank reserves and also the Fed balance sheet here to really make sure. And then we're going to go through the S&P 500 during certain catalysts. So you can actually see during this time period. So let's go back to bank reserves. During this time period, August 2014 to September and October 2014. When we go back to the S&P 500 during this time, it was a very interesting moment where this essentially ended a pretty strong secular or a pretty strong cyclical bull market run. So when we look back at September, October, when the Federal Reserve actually guided towards balance sheet runoff, um, so like let's actually go right here, or they weren't going to do any more QE. So essentially what they ended up doing. So you can see right here when they did stop doing the QE during 2014. So you can see 2012 they initiated more basically buybacks, or QE is what we call it. This is kind of the slang lingo. So then you can see October right here is when they stopped buying more. From there, the stock market actually ended up stagnating out for the next 2 years. And I actually marked this black line right here until basically when we go back to bank reserves. So until the bank reserves, right here was going to be that 2016 marker. So right here, January 2016 is when the markets bottomed during that time frame. So from October 2014 to 2016 to January 2016, the markets essentially went nowhere, and they actually traded downwards from there. This essentially basically created like multiple contraction in a lot of the S&P 500 stocks, and was a very difficult time for some investors. Now, it's not necessarily that this isn't going to be like something to, to throw your hats off and be like, maybe it's time for me to sell stocks or anything like that. But I want to make sure that I'm putting on like how important making sure that you pay attention to the bank reserves and the Fed balance sheet. This is a super complex topic, and it's actually kind of difficult to talk about. But when you start thinking about all of these things together, you can actually see that the stocks, or that stock prices do move directly along with a lot of these catalysts here. So going back to 2018, when the Federal Reserve started their quantitative tightening program that time too, let's go back to the S&P 500. So when we go back to January 2018, so right here, January 2018, and then we peaked here in 2018 for the next couple of years actually. And this is when the Federal Reserve started their quantitative tightening program, but they went directly for bank reserves during this period of time. So we can go back to bank reserves, and we can see the January 2018. So boom, right here. And then you can see that the bank reserves actually started declining during that time. So basically we had a period of time here where bank reserves from January 2016 to about, when they actually started doing QT in 2018, that it was basically flat. And that was enough for the stock market to actually be able to rally. And now the Fed kept on going until about 2019. And then when they actually did the notorious Fed pivot, where they said that they weren't going to do any rate hikes in 2019. So that transitioned us to a lot more of an easing cycle. Okay, I got to make sure that I'm not losing anybody here. So I'm not sharing. I'm so sorry about that. So let me actually go. Why is this not sharing? Okay. These are always live. So you can actually see, let me go back to the S&P 500. So let me do a quick refresh because these are live. So I do apologize. This is what I was talking about from 2014, right? So October 2014 to January 2016 when the market and then the bank reserves essentially went nowhere, right? And then this is also the January 2018 marker here until the Fed. So this is when they actually began quantitative tightening. And this is indicative of this right here. So you can go right here, January 31st, 2018, when the balance sheet actually started declining during this time. This is the Fed's balance sheet. When the Fed's balance sheet started declining, then that's when you actually go back to 2018 and the S&P 500. This is about the time when we saw the stock market essentially go nowhere for the next 2 years, or about a year and a half, I should say, about a year and a half, until the Fed did pivot and they said, hey, we're not going to do any more rate cuts. So let me actually make an important point here where, yeah, I know Sam's laughing at me. So essentially what I'm saying is that from 2014 to 2016, that was the last tightening cycle that we ended up going through. And then when that didn't actually end until the Fed pivoted and they said they weren't going to do any more rate cuts or rate hikes. Rate hikes in 2017. But essentially, when the balance sheet contracted, this basically think about it like this, like the ocean of money, right? That's the best way. I'm going to actually make an analogy to. I think it's going to help me explain exactly how I'm thinking about this. Think about like an ocean of money, and that ocean of money sloshes around throughout the economy and the markets. When the Federal Reserve does QT, what they do is they basically lower the levels of the ocean of money. So that means that there's less money to buy stuff, right? But less money to buy treasury bills, less money to buy stocks. And what this does is this actually impacts the stock prices in the stock market. Not just the large caps S&P 500 stock prices, but actually a majority of the stocks in the stock market, both small caps, mid caps, high beta, low beta, non-profitable tech stocks, like all of them that you can think about. And this is essentially what ended up creating the crypto phase of 2020, 2021, is because the Fed's balance sheet expanded so rapidly. And we're going to talk about that here in a second. So let's go back. I'm going to make sure that I'm actually sharing my screen this time. So when we go back to the S&P 500, so coincidentally, the next time that we actually ended up rallying was back in October of 2019. And when we go back to the Federal Reserve's balance sheet, these dates they're not a coincidence. October, September of 2019, when the Fed started their not QE program, where you can actually see that this expanded until the end of 2019, and as a subsequent result, that we saw a pretty significant rally in stock prices during this time, all the way up until the COVID-19 pandemic. Then we introduced the COVID-19 pandemic. We locked the world down in response. We talked about that a little bit in the beginning of this. Government printed a bunch of money. And then as a result, the Fed's balance sheet expanded rapidly. When the Fed's balance sheet expanded rapidly, this sparked the next significant bull run. And now this is what's really interesting here, guys. So when we go back and we think about exactly the peak in the stock market, so the exact peak in the stock market is directly correlated. So if we go back to the S&P 500, so the Fed essentially did QE for a long period of time, and now the Nasdaq peaked in November of 2021. The S&P 500 peaked in December of 2021. When we go back to bank reserves, we can see that the peak is going to be right here, September 2021, December of 2021. Once bank reserves started declining, the S&P 500 started declining. Once the bank reserves stopped declining, so you can see right here, January 2023. So we got September 2022, January 2023. Go back to the S&P 500. We got January 2023. So basically, and then we got the September timeframe, September and January. So basically, we can actually see what the action that bank reserves do, and when bank reserves expand, the S&P 500 expands. And the same thing ends up going on with the Fed's balance sheet here too. When you can actually look back at like this December of 2021 timeframe, and let me scroll down a little bit. December of 2021 timeframe, the S&P 500 went down all the way up until about that March 2023 timeframe. But once again, we go back to the reverse repo market. So let me make sure that I'm contextualizing exactly the point that I'm trying to make here. So thank you, Sam. Thanks for confirming that I'm sharing. He's on YouTube. I get comments from both X and YouTube. So if you guys can't see exactly where the comments are coming from. Okay, so the point that I'm trying to make here is that we're currently transitioning to a balance sheet. So like the QT program is going to slow substantially. The Federal Reserve is thinking about making sure that they address the reverse repo market. But the risk starts to come when the reverse when the reverse repo market hits zero. When the reverse repo market hits zero, it's going to start impacting bank reserves. When it starts impacting bank reserves, then I do believe that that's going to be the catalyst in the moment where the S&P 500 does start declining. And this goes back to my analogy when we're talking about the ocean of money, right? The ocean of money, most commonly shown by bank reserves or the Fed's balance sheet. When the ocean of money starts going down and the tide starts to decline, just like the analogy goes, you find out who's swimming naked when the tide goes out. And that's essentially what I'm thinking about here, right? So there's a lot of speculation, that there's a lot of euphoria in the markets, and the title of this video is Navigating 2024's Traders Market. So in 2024, and like this is going to bring me to the next thing that I'm going to be talking about here is I've never really seen this sort of bifurcation in the markets before. And I do think that going back to Jam and Ball, I talk about Jam and Ball stuff all the time because I absolutely love it. Read it every single Friday. Highly suggest that you guys follow this guy right here at Jam and Ball. I've never quite seen. Hold on, I got to make sure. I did. I double checked. I was not sharing my screen. Okay, I've never quite seen the valuations right now in a lot of these software companies have this kind of spread before. What I mean specifically by that is like this EV next 12 months. Like these three stocks. I actually own Cloudflare and Palantir, so it kind of makes me nervous. These three stocks right now. So Cloudflare, CrowdStrike. Try say that. Cloudflare, CrowdStrike. It's like Dr. Seuss book. These three stocks are actually really, really high valuation right now. The next closest is going to be Samsara and Datadog and ServiceNow. But right here, from like basically Datadog down, this actually makes a lot of sense, right? Because Datadog has a pretty healthy free cash flow margin. ServiceNow and Snowflake also do as well. And they're all guiding for about the same kind of growth. But then all of a sudden, you get these top three stocks right here, where they're kind of like the anomaly, right? So essentially, the way to think about that is that right now they're kind of a I think they're called tails in the law of statistics, or in statistics they're called tails. So essentially, like these companies right now, they're trading at a lot higher of a multiple. So this goes back to the point that I'm trying to make about this market, where it's really interesting, is that you do see these companies trading higher on basically inline results, but they guided up just a little bit. So if we actually go back to CrowdStrike, so CrowdStrike is the perfect example right now. So I ran valuations for my Savvy Trader subscribers for a lot of the companies that so I can actually show you. I'll probably show you this one here. So I ran valuations for a lot of my Savvy Trader subscribers. So when I ran these valuations for my Savvy Trader subscribers, I started to notice something that was really interesting, is that a lot of companies right now, a lot of software companies are really undervalued. But we have a couple of them out there, such as Palantir and Cloudflare, as well as CrowdStrike, that right now, they're not like they're okay. I got the valuation metrics pulled up here in CrowdStrike. So like right now, these are actually trading really high. So I think that the valuation is pulled forward on a lot of these companies. So basically like the winners of 2024 so far have seen really nothing much more than multiple expansion. So like you guys can actually see my numbers here, and I'm going to leave that for a lot of Savvy Trader subscribers. If you want to actually see all of my work and all the companies that I'm covering, that's obviously going to be there for you guys. But what I basically have is I have the stock price basically moving nowhere for the next 1.5 years, just assuming a moderate multiple of basically 10 to 15x, right? Next 12 months EV to sales. But right now, you're getting a lot of like chest beating and talking about how awesome this company is and how everyone can't, like they're fumbling over themselves to buy these companies. But like if there's one thing that I ended up learning from the 2021 to 2023 market cycle, is that like I saw Snowflake go public at about 225, 240 dollars per share, and people just couldn't stop buying this company. And I saw the stock price actually run up to about 400. And at one point, it was trading at 100x next 12 months EV to sales. So 100 times price to sales, basically. And that was wild, right? And what I'm seeing here today is that people are still buying these companies right now that are very, very expensive. And it's not that I'm not bearish on CrowdStrike by any means. I'm basically talking about how when you actually go back to CrowdStrike's earnings. So let's go back to these earnings here. And so they basically guided in line is what they basically ended up doing. So I'm trying to find exactly where it is here. So they ended up doing like less than a 0.1% guide up. And when we saw that 0.1% guide up, CrowdStrike actually went up 20% that next day. And now they've continuously drifted a little higher. So you can actually see the stock price movement here. So from the beginning of the year, so this is January 2024. So CrowdStrike has seen really nothing much more than multiple contraction or multiple expansion. When you go back and you look at my numbers that I ran in Savvy Trader, you can see that I have basically the 200-day moving average priced out, which is significantly lower from where it's trading at right now. Okay, so that was CrowdStrike, right? Cloudflare did basically the same thing, but what I ended up seeing was this other anomaly here, with like GitLab, right? So like, look at this. They ended up guiding to 725 to 731. So I actually did the math at the midpoint. This is a 0.5% miss to the downside from consensus. And I know that earnings kind of came in a little bit lower. So this is basically a 0.5% guide down on sales on a full year sales basis. But the stock price was absolutely hammered, right? So you saw GitLab ended up reporting on like March 4th. And then they ended up trading down they went from $74 all the way down to $50 per share, which we were buying in the Savvy Trader portfolio. So on a 0.5% miss, Now, CrowdStrike on the other side, on the other end of things, they basically guided up like 0.2%, 0.5%, but that justified a 20% rally the next day. Now, this has also ended up happening here with Sentinel One. So Sentinel One, same thing, right? So you can actually see right here that they guided to 812 to 818, and then the midpoint was apparently supposed to be 817.5. But this actually ended up creating a pretty massive sell-off in the stock, which it declined about 20%. So you can see when they released earnings here, and then once again got absolutely smacked down to about $20 per share. And now it's not even in the top 10. I think that the multiple right now is like 8x next 12 months EV to sales. They're expected to be free cash flow positive. So there's basically nothing wrong with the business. And then to call out one of the companies that I own right now, like Palantir. So Palantir did the same thing. They didn't even actually guide up. I think that they guided mostly in line. And if there was a guide up, it was less than 1%. I'm sorry, I got my dog here. Cody, go lay down. It's the kind of the thing of going live. But the guide up was basically nothing more than like 0.5%. But once again, it justified this massive movement in the stock. And I love Palantir, right? I own Palantir. It's one of my biggest winners. But when I see this kind of behavior, so that basically what I'm seeing here in the markets is that I'm seeing this behavior of if you slightly miss earnings, your stock's going to go down 20, 30%. If you even like slightly guide up earnings, your stock's going to go up 20%. I've never seen a market cycle like this before. Usually what ends up happening is like I mean, if they so like CrowdStrike's earnings could have justified a move a lot more along the lines of like, I don't know, maybe like a 5% move the next day. Whatever happened to 5% moves, but like a 5% move the next day, or maybe like a 2 or 3% move, because it was less than a percent guide up, right? It was a 0.5% guide up. And then same thing with GitLab, where they guided down 0.7%, 0.5%, and the stock got whacked like 25, 30%, and it sold off. And now this company is both free cash flow positive, guiding for 25% revenue growth for the next 3 years. Like, it's a compounding machine. So essentially what we're seeing here is we're seeing this crazy bifurcation in the markets where it's the 2024 traders market, where there's going to be certain companies right now that are absolutely just crushing it. And then we got these other companies that are still producing great results, but they're being completely left in the dust. And this is crazy. I've actually never quite seen this, because it can be in the same sector too. Usually you see different sectors start to rotate, and we do see that. We have seen that. Like XLI, the industrials, XLU has been doing pretty good. XLE is doing pretty good. So you're seeing sectors broadening out, which is a really optimistic thing to think about. But like you do see, what was it, Lululemon got absolutely smacked after hours when they released earnings that didn't necessarily come in to the best of expectations. I mean, it wouldn't surprise me to see further weakness in that stock price. But then again, I mean, like, and then you get these companies that are barely beating right now, and then they're absolutely just getting rewarded for these premium multiples. Going back to like what I was saying here before, so like we can go back up to here, going back to, and I got to make sure I'm sharing my screen because I can actually remember to do that now. So you can actually see that once again, we're seeing this crazy difference in basically the top stocks that have performed very well this year, and then the stocks that haven't performed well at all this year. Now they're actually trading at what I would believe is bargains. So like I do think a lot of these companies are actually trading at really, really, really great prices. So like even in the event of a correction, I mean, I do fear that I think that a lot of these stocks are probably going to experience weakness in the event of a correction. But like when you look at these prices, it brings me to believe that there's a lot of deals in the market right now. But these deals, you got to actually like know what you're looking for. So like, where's the company right now that had that 0.5% miss? Because all it takes is for one more quarter's earnings. So like GitLab comes out, raises their revenue expectations for the full year, which they probably will, and then says, hey, maybe EPS is going to come in, 1% better. Maybe revenue is going to come in like 1% better. And we're going to see the stock price surge 20%. And the next thing you know, it's going to be in the top 10 as far as revenue or as far as multiples go in a lot of these stocks. Same thing with Sentinel One. I mean, this company is like 2 seconds away from becoming free cash flow positive. And I could see this actually hitting like 12 or probably 12 next 12 months EV to sales. And right now it's at like 8, right? So I think that right now there's a lot of opportunity in the market. And as I'm running the valuations in my portfolio, so let's go to my Savvy Trader where I'm actually running this here. So you can see that I did CrowdStrike, and I'm going to go kind of fast. You can see that I ran the numbers on Palantir here as well. And you can see that even I'm bearish on Palantir, where I say basically that I think that right now they probably are going to be down on from here, which is like 30% lower, is basically where I think the Palantir could trade to. Right? If they do that, I do think that's an opportunity. I don't think that's going to happen this year. There's a lot of weird things. There's a lot of really great things going on with their business and their go-to-market strategy. Same thing with MongoDB. Got absolutely smacked, right? But when I run the numbers, what I'm seeing here is that I'm seeing basically 21% upside from here to the end of the year. But I could actually see somewhere around like a 46% upside if they actually come in better than expected and they receive the multiple that they end up deserving. So like when I put down the numbers and when I list out the numbers and actually look at, like what I like where the opportunities are in the market, there's a lot of them, right? There's actually a lot of opportunities right now. So I think that it goes back to like where I'm going to leave you guys here because I'm at about that 35-minute mark. Um, so I'm going to leave you guys with this. So I think that I didn't even share my Savvy Trader part, did I? Let me see. So this is what I was actually sharing here, right? So you can see that this is my MongoDB numbers right here, where I think it's probably about 21% upside from here to the rest of the year, plus 46% is what I think on the high side, and you can actually see. All right, going back to where I think that where I want to leave you guys here. So I think the point that I'm trying to make is that there's going to be times in the market where there's going to be a business that's going to be up here, or the stock price that's going to be up here, right? Which is basically like these spikes. And then there's going to be times where the stock price is below this basically business. So like you can see that solid yellow line. This is basically like the intrinsic value of the business. And there's going to be, and this is essentially what you should be paying for the stock. There's a lot of stocks right now that are trading below this intrinsic value. And right now there's a lot of companies that I own right now, like Palantir and Cloudflare, that like I'm pretty bearish on the stock price. I'm not going to short them. I don't try to short companies because it's kind of a losing game. Especially when you think about like from a business performance perspective, expensive can get more expensive. But I do think that there's a lot of opportunities in the market. Right now, there's a lot of damaged stocks in the market. I do think Tesla is one of those damaged stocks in the market. I think that GitLab or Sentinel One or Snowflake is a damaged stock, but like these are not damaged companies by any way, shape, or form because they're still growing their revenue, earnings, and cash flow. I do think that there's a lot of companies right now that if you buy them like right now at these multiples, next year it's going to be higher, and I think it's going to be about 20 or 30% higher from right here. With a lot of companies right now. But there's going to be a lot of companies like CrowdStrike, Cloudflare, and then Palantir that could actually be lower or go nowhere for the next 1.5 years, maybe even 2 years. So that's something to pay attention to. I think that's exactly where I wanted to leave you guys off at. Never hesitate to leave any sort of recommendations, what you guys want me to cover in the comments section down below. If you don't already follow my Savvy Trader, I think that I might be running a coupon code here pretty soon. So make sure you pay attention to that. I might do a couple percentage points off on like a monthly subscription or whatever it might end up being. So pay attention to that. I'll probably post that on X. And I always appreciate you guys for coming. And then until next week, of course, you stay classy.